Hey everybody, welcome back to the Teaching Tax Flow Podcast, episode 164. Today, we are looking at FAFSA. That's that free application for federal student aid, and of course, tying that into tax planning and strategy. But before we introduce our guest and this topic, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
So we are going to really dive in and look at yet another acronym. I know my co-host here is going to love this one. We are looking at FAFSA. So if you're not familiar with what that is, you may, if you have a younger child, and you may absolutely despise everything to do with it because you may be that confused with it. So we are going to connect some dots. We're going to dive in. We're going to clarify. But as always, Chris Picciurro, welcome back to your own show, sir. We open the door. We let you back in. Hopefully you got some good for us.
Well, John, I think it was the first time I ever had my Teaching Tax Flow sweatshirt because it is the wintertime, even down here in Nashville. But great to be back. I'm excited about this topic because we've been waiting to have a special guest on to talk about financial aid planning in the FAFSA application. There's also another application that some private schools utilize, and talk through when you have children that are approaching that college age. We're going to talk about when you start thinking about it. We know that there's a little bit of a delay or look back on tax returns. So your tax return for much of this is the driver in your college aid application, but there are also tests based on your assets. But yeah, so I mean, quite frankly, personally, this is something that my wife and I are working with. We've got our junior in high school, sophomore in high school, and then our youngest is a middle schooler. But really excited to welcome a special guest, Brian Eyster. He is with Essential Strategies and is an expert in college aid planning, FAFSA planning, and planning for your children's education. So, Brian, welcome to the Teaching Tax Flow show, or podcast, I should say. No, and John, I just went from a podcast to a show. I don't know if that's right.
You know what? We're stepping things up a little bit. And, you know, one of these days we're going to have to retitle this and be like the enterprise, the mecca of all things tax. We'll get like a bot to say it for us. But let's, and Brian, before you get into this, actually, I'm going to put out this challenge to you guys. So we have a small window here on this show. But if you can, and I'm going to throw out another acronym. If you can convince me that FAFSA is not a PITA, I think we've done our job. So if anybody's familiar with what PITA stands for, PITA, it's a pain in the beep. So let's throw that out and see if you boys can do it.
See, here I thought when you said PETA, you were talking about the animal, the nonprofit animal company there. You threw me for a loop there for a second. So
Good.
I was thinking about bread at a Greek restaurant.
That too. Thank you, gentlemen. Appreciate your time. We have commonality. We all share at some point Michigan roots. So
Yes.
and a love of baseball and all things Tigers. Unfortunately, didn't work out well this year. But you know, perhaps if we got some better hitters, we might get there next year.
Agreed. So Brian, can you give us an idea of who you help out right now? Kind of, what families, and when someone should start thinking about planning around their children's, or it could be, I mean, maybe they're a guardian, maybe it's maybe they have custody of their grandchildren, their college financing, because college ain't free. I mean, sometimes it is, I guess. And there are some, based on your the financial condition of your household, the financial condition of your household could drive a lot of financial aid, scholarships, potentially grants. I mean, I want to talk on a, kind of a 30,000 foot view level of what does the government consider part of your household financial snapshot? Is it income? Is it assets? Is it a little of both?
Excellent question. The best way to phrase it is think of yourself playing a chess match. You can win a chess game with a multitude of different strategies in place. So there's no right or no wrong. So keeping it at the 30,000 foot overview as we discussed today, let's start first with FAFSA. What does it mean for the families that are familiar with it? What do they need to do? What are some of the checkpoints, things to be thinking about? FAFSA is an acronym, obviously, free application for federal student aid. It is the federal program. What that does is it takes into consideration your incomes, your assets, where they're positioned, and while they don't disclose on their website how the sausage is made, it comes up with this number now known as SAI, Student Aid Index. It used to be called EFC, Expected Family Contribution. Don't know why they changed it, doesn't matter. It is what it is. The whole goal of these forms and pairing with a professional like myself and partnering with you and your accounting skills for the business owners is whatever that number calculates at, our job is to try and get it lower and lower and lower, legally, ethically, and morally. So, for parents that have aspirations of helping out their children for school, there's 3 phases. The first phase is essentially from birth until 9th, 10th grade. Just focus on good savings habits, good investing habits, getting your financial house in order, things of that nature. Nothing permanent or final has to be made at that point. Sophomore year, I would recommend and encourage people to sit down with someone like myself. While they don't have to make any decisions sophomore year, they can get a feel as to what it's going to look like. On our pre-show talk, Chris, you were mentioning that you have a junior. I am busier than ever right now with 2 facets. I have the high school senior families. What are we going to do? They're doing applications, they're filling it out, they got to submit FAFSA, the CSS. All we can look at right now for the high school seniors is what sort of assets do they own and how is it impacting their FAFSA score? For parents of juniors like yourself, this is your last chance to do anything proactively regarding your income. See, in FAFSA, the tax return is prior. So I have a high school senior as well. They look at the junior year tax return. So for parents of juniors like you have right now, this is the time where you talk with your professionals. Do you contribute more to your 401k than what you normally do? Do you set up a higher bonus or some sort of deferred comp or something that is considered a qualified plan? These are all not to be taken lightly, but to be discussed with your professionals because we know that there's pros and cons to those as well. And it also depends on where your income is, how much you can drive it down. Is it even worth it?
So if I talk to myself, then I'm okay right now, since I am a tax professional and I have a junior in high school for
Yes.
once.
So
No, I understand. So whatever is reported on someone's 2025 personal tax return drives the fall of 2027 enrollees. If it's
it is the 2024 return. So we are in 2025. So your junior, yes, when they are getting ready to I'm sorry, I was thinking of my daughter. We're talking about your son, junior, senior. So 2025 return impacts a student entering school fall of 2027. So you have until December 31st of this year. Perhaps, I don't know the rules you would. There's things that maybe you can do up to the tax deadline day of April 15th to help lower it, because if the parents' incomes are assessed at a rate of, have it right here, between 22% and 46%. Okay, so that's the assessment rate on one's income. If the income is lower, it's going to be more towards the 22%. If the income is higher, it's going to be more towards the 46%. Okay, assets that the parents own that are assessable, 5.6%. Another thing that parents are unaware of when it comes with their children, it is highly inadvisable for your children to own the assets at the time that you are completing these forms. Students, incomes above and beyond a certain threshold, like a standard deduction in tax terms, there's about $7,000-8,000 that a student can earn before they're penalized. Anything above and beyond that income level, they're penalized at 46% right off the bat. And their assets are 25%. So much, much more penalty if the students are owning it. So it's advisable for parents to own the assets as much as possible. You can also get into asset shifting with grandma and grandpa if there's good relationships there, and there's trust, because the tax return is a tax return. FAFSA, you sign off on it, you have to go into the federal center, and FAFSA will pull your tax returns from that portal. Okay, there's no way around it. Assets are at the time that you file. So today is Veterans Day, November 11th. If I'm sitting down and I was working with a professional, I might have had assessable, heavily penalized assets up until yesterday, November 10th. Today, with proof and documentation, meaning take screenshots, PDFs of where you're at in case you're audited. With proper planning, you could make yourself look broke.
So with FAFSA planning, there's two components, right? There's the income side of it,
Yes.
which is now with technology, that's going to get pulled directly from your tax transcripts. Just like
Correct.
when you apply for a mortgage, they pull your transcripts. Then there's your personal asset list or balance sheet that's
Yes.
self-reported. And within those assets, they're countable assets, cash, savings accounts, money market accounts. Then there are non-countable assets like primary residence, et cetera. So someone could, let me give you an example. Let's say, and we're not giving out any financial advice here,
Correct.
but let's say you had $100,000 sitting in your savings account.
Yes.
And you had a home equity line of credit of $150 that you owed on. It might make sense to take the $100,000 and pay down the equity line because you're basically taking a countable asset, reducing that, but not hurting the non-countable. I don't know if that would make sense, but
Makes total sense. Just an example. Not knowing, we don't have a client in front of us and saying this is what they do, but yes, on the FAFSA, your primary residence, the equity is not assessable. On the CSS profile for private schools, it is. Okay, so it's a different. There's a different play there. But since we're talking FAFSA, the equity in your home, you can ignore it. The number one mistake that I see that families have is if you go onto Facebook right now and you go to any college planning forum, the number one question is, how do I accurately value my home? And and I laugh because nobody knows. No one has a hard, definitive answer. And I just let it go because, Chris, you try and be nice in those groups and you just get flamed. Some people go to Zillow. Some people talk to your realtor. Everyone has an opinion. I have one designation right now. It's the Certified College Funding Specialist. I have completed my coursework for a second designation, which is a Certified College Funding Counselor, CCFC. I'm waiting on my test results back. In that class, there is a federal government website. I have it here. Let me just pull it up that you can go to. And in the coursework, you go there, you type in your zip code, and it will give you an estimate of your home's value, not the city that you live in, based on the year that you bought it. And it's all documented. You can screenshot it. You can print it out. It's in my coursework. It says, go here, put in your info, then you get the value. Let's say your home is 300,000. Cool. The IRS allows what they call a fire sale. So you can take the 300,000 value and you can discount it by 20%. Because if you had to have a fire sale and get at it and get your assets, you're not going to get full market value. There's not enough time to wait through, a market and the peaks and valleys. So the FHA website that you can go to, and I will send you the link where you can post at the bottom when this gets promoted. And number two is you can discount it by 20%. Same with your business. So business and real estate, you can discount by 20%. That's the number one overlooked item that families just aren't aware of. They don't know what they don't know. Number two is retirement accounts. Any existing account balance, 401k, 403b, IRA, you get it. The ABCs of retirement planning. Those also do not need to be disclosed. And based on who is in office at what time, your 401k contributions could be assessed, could not be assessed. There was a couple years ago, they would take your 401k contribution, and when they're making or figuring out your SAI, they would add it back in. That is not the case right now. Could that change? Absolutely, it could.
Oh, sure. I mean, yes, we are running, in a world where anything can change. And so asset planning is important, especially for FAFSA. You mentioned CSS. Now, I'm a little familiar with this because I went to a workshop about this topic, and many private schools have their own way of determining what we used to be called the family contribution should be. In other words, what your need is financially. Can you compare the CSS? Yeah, I know you mentioned there's a balance sheet, a little different on personal balance sheet component. But yeah, can you compare CSS to FAFSA a little bit?
Yes. So similar concept to the FAFSA. I like to joke around that it's as long as a fiction novel and as intrusive as your mother-in-law.
Good
It's
thing my
very
mother-in-law doesn't listen to this show.
Yeah. I love my mother-in-law. Don't get me wrong, but it's they ask you everything. Literally, it's just as detailed as trying to get yourself a mortgage, or you're filling out your health forms at the doctor's office. They're getting into everything, and here's the reason being: private schools are private, so they are relying on alumni and donations to fund their coffers. So therefore, private schools are going to be a little bit more selective and not as nonchalant, let's just say, with the federal schools or public universities that rely on federal dollars, because we all know how that works in terms of waste sometimes. So they're going to ask for your income, your assets. And they're very quiet as to how they come up with their calculation. You hear like that some retirement plans can be assessed, others don't. There are also some schools that will require you to fill out a additional university specific form. So let's just take University of Michigan here, just down the road. You have to do the FAFSA, you have to do the CSS, and then you have to fill out their own form. And so that's why it's incredibly important, Chris, with families is if your due date to get your financials are next Monday, you got yourself a challenge. So that is why I encourage parents of sophomores to start thinking about this, talking with a professional, because then you have to make final decisions their junior year that you're comfortable with, that lowers their income as much as possible, but doesn't negatively impact other financial goals that they have down the road. That's why it's important to engage in a dialogue with a financial professional. Well, what about this and what about that? And then the asset assessment doesn't happen until the child's senior year. So it's really three main phases. It's up to sophomore year. Sophomore year, sit down with someone, spend a lot of time in the batting cage, getting your reps in, playing what ifs, crafting your swing, because it's going to be game time their junior year and extra innings senior year.
I like the analogy. So when we talk about college aid, what are some of the things available to families. I mean, I would imagine, subsidized loans, private loans, grants, scholarships, and what's the correlation between a household's income, or no, it's not necessarily a household's income. The CSS and the FAFSA are both assessing the same thing: a household's on paper ability to pay for the cost of a student's college. If you could describe that interplay to us?
Excellent. So the SAI number, there's a different set of calculations for FAFSA, and there's a different set of calculations for CSS. Looking at my own situation last night, my CSS, while it's more invasive and it's more detailed and more time consuming, is considerably less, like $5,000 or $6,000 less than what my FAFSA is. Okay, just on how the assessments are. The lower the number, the better the chance for a family to qualify for need-based financial aid. So that's going to be need-based financial aid is going to be student loans that are subsidized. Your grants, like a Pell Grant, is the most popular one, things of that nature. Merit scholarships or other financial aid offers require the FAFSA, but it's not financially driven. It's academically driven. I don't know why they require it. It's just the rules. It is what it is. Now, for folks that earn good wages, good incomes, they think, well, why do I even bother, Brian? It's just a waste of time. I'm not going to qualify. I'm making, 200 plus of combined income total. It's important, like I said, because merit scholarships, they require the FAFSA. So you could have a student that is very attracted to that university. The university wants them, are willing to offer some extra dollars, but because mom and dad didn't fill out the forms, they're on to the next person.
Wow.
Yes.
Now the FAFSA form. Oh, go ahead. I'm sorry.
Yep. And then the last piece is that even if you don't get anything, no financial aid, no need-based aid, not even a token $1,000, here it is. Do it anyway the freshman year. What if your circumstances change? Think of COVID and what happened to people in their businesses that lost everything, that were making healthy six figures, that their child, they didn't qualify for financial aid. So they didn't fill out the forms. Now, at the gym, the local gym down they shut down, they moved on, or a small restaurant. Now they need financial aid. All these universities, Chris and John, they're like, well, you told us freshman year you didn't need any financial aid. Well, we can't help you. You didn't. So it's almost like do it even if you don't expect to get anything, because you don't know what your situation in the world is going to look like sophomore, junior, senior, second senior year. If you're having a great time, maybe third senior year.
Maybe Van Wilder year. Well,
Exactly.
Redsker year. So the FAFSA, this is not, just so I understand, this is not something that you just do when they're in college. This is filled out each year?
Yes.
And
Thank you for bringing that up. Another common overlooked item, you fill it out each and every year. I will sit down with folks. So like this time last year in the fall of 2024, I'm talking with folks and they're like, oh my gosh, where were you 6 months ago? Because we already filled it up. Okay, well, depending on the university, they may let you amend or appeal at semester break. Not all, that's very niche. But if you, I spend, John, I spend time on the websites. I love detail. I'll read through every single tab and link that, my oldest daughter's at Wayne State right now. We went through a bunch of stuff. I knew what was on their website more than their admissions office did. And so if you go through, yes, you can appeal your age. So as an example, I could appeal what my oldest got up until December 1st. So it's not like when they start the calendar year. So for most people, it's that last week of August, first week of September. That's number one. If you made omissions or errors, like including the value of your 401k, including the equity of your primary residence, just use those two. you
Mhm.
can go back into FAFSA and make an amendment. So just because I know of people that were they're just, I got to get it done. October 1st of this year, it opened up. People were in the portal, filling it out, completing it. Great. I will get around to it after Thanksgiving weekend.
Now, yep. So no, so I'm just talking about that FAFSA.
Yes.
It sounds so when the tax records are pulled, is it the adjusted gross income that is your driver?
Yes. It is the
'Cause
adjusted gross.
so tax planning, think about this, people listening, we're working with, so if you have a large itemized deduction, charitable contributions, mortgage interest, property taxes, or if you get a large tax credit, research and development credit, energy credit, those could be positive on your tax return, but they don't reduce your adjusted gross income. The AGI is your number one driver from your personal tax return to FAFSA to CSS. And so not every so a business deduction on a Schedule C, for instance, for someone self-employed is more valuable than a tax credit, maybe, or a Schedule A. So there's a lot of factors involved.
Yes. Yes.
I know there are a lot of factors, and I know that you launched Essential Strategies, and something
Mhm.
really cool about that you've done is you created a proprietary process for helping families out. But can you give us an idea as we wrap up? What is the grad process? I love the acronym, by the way.
Thank
And
you. Thank you.
when where's a good place? And then we'll put it in the show notes for someone to go, a family to go to discover if it's a good fit for you guys coming together.
Excellent. So the grad process and the acronym was developed early 2024. I was sitting down, kind of sketching out, working with a marketing team because that is not my forte. I'm a detail. I'm not the big picture kind of um, artist. And they're like, well, what do you do with clients? And so G is clients come to me, they're overwhelmed, they're anxious, um, they don't know what to do. They want to help out their kids, but they don't know how much they can. And whoever they are working with in the traditional financial advising community, not a knock on them, but they don't have any tools or resources to look at this similar parallel path of college planning as well as retirement planning. And what was actually happening is that there was conflicting advice happening. So you're taking one step forward, but two steps back. So G, the grad process is just basically, where are you at? What are your goals? What are you looking to accomplish? What sort of holes in the bucket that you just don't know because you don't know are happening? Um, if you could wave a magic wand, how would you design and structure for school? Like, do you want to pay for it all together? Do you want to have your children have a little bit of skin in the game by taking out student loans?
Mhm.
But if they get all B's or higher once they're done with school, you knew all along that you were going to pay off their student loans, but you want the kid to you know have a little bit of a stake in there, things like that. And then just a constant monitoring. So, every quarter, every year, working with families of what they can do to lower that cost as much as possible. Because every dollar that a family uses out of their own pocket, as you know, based on prior podcasts that you've done, creates a lost opportunity cost. When I sit down with folks and they look at the average cost of school and they calculate it out, it's easily 30, 40, $50,000 a year of lost retirement income. So, sitting out talking with parents, Chris, at the Ball Diamond in right field, which is where I hold court, this whole idea, that was the genesis. Just sitting down, I'm like, well, what if I created this grad process and show them how to pay for their kids' school and get a pay raise in retirement? Meaning, use the most efficient dollars. Try and use as much of other people's money as possible. Utilizing the tax code that you're so knowledgeable of with the business owners, which we didn't even really tap into, but there's like a section 179 or the medical, what is that? The ones, not the
Bonus depreciation, yeah.
bonus depreciation, the The one where a company could set up a student loan repayment plan. I forget what the number is there, up to $52.50 a year.
Mhm.
All kinds of things.
Educational assistance program. Yeah. Yeah.
Yep, yep. And so that's how the grad process started.
That's all. And what's the best place for someone to reach out to you uh, as a next step to if they're interested in working with you and your team?
Excellent. I would encourage them to go to my website, www.essentialstrategies.net. I'm sure you'll have it posted at the bottom, and spend some time on it. I have a resource section that they can on one of the tabs where they can click on, learn more about how the SAI is calculated, some general student loan information, just some basic stuff where they can kind of kick the tires and see, hey, is this worth a conversation? And if they are compelled, on every page of my website, they can book a 20-minute call. And all we're going to do in that call is determine if we get along and we like each other. It's my number one rule of business is, are we going to get along and can I work with you?
And that's honestly, guys, I think you accomplished the challenge. It's no longer such a pita. So good job. You you get a gold star, as we tell my 4-year-old at daycare. It's like, good job. You accomplished a goal. And I know, guys, it might seem like we're kind of cutting the legs off this a little early, but even though we've had 30 minutes to talk about this, right? Basically scratch the surface. You can go off in a million different directions, but I think the one thing to take away from this is just the knowledge of these that exists in different situations, but then also aligning yourself with the right person. Chris, as we've been mentioning since day one here, right? It's finding the right individuals for your personal board of directors. And Brian, it sounds like you would be a great fit for somebody that's looking for somebody that they can have in their proverbial Rolodex, right? Of somebody they can lean on for that information. So we'll be sure to put some stuff in the show notes as always, and that way they can reach out. Because again, this is not something that's going to be, the curtain is not completely dropping after 30 minutes. There's a lot that goes
No,
into
that's a
this and
lot.
planning too.
And yeah, and
Yeah.
like you said, John, your tax return's the driver, one of the two, other than your personal balance sheet, in this aid journey, financial aid or financial need journey. So it's unique for everyone. There's special rules for rental business owners, and so yeah, definitely reach out to Brian and his team, see if it's a good fit. And I'm happy that we're able to do this episode. I've been wanting to dive into this topic for a long time. So Brian, thank you so much for joining us, man. I appreciate it.
Pleasure's all mine. Thank you. Really appreciate it.
Awesome. Well, thank you, gentlemen, both for joining us on this one. And Brian, thanks for taking the time. And it's always easier when we have a guest, so me and Chris don't have to sit there and stare at each other. And I don't have to ask the tough questions he doesn't want me to, and I don't feel like I'm putting him on the spot. So it works out well. We get to put him on you. But thank you guys so much again. Great topic. There'll be more to come on this. And again, if anybody has specific questions, send them over to Brian, send them over to us. We'll relay them out. But the only wrong question is the one that you don't ask. So take that into account and remember that. I think with everything in life, right? Maybe just don't think about this when you're at a red light, because that's a whole other situation, especially if you're in Michigan, you'll get rear-ended if it turns green. I can say that, Brian, because I live here too. But again, everybody, we'll see you back here again next week on the Teaching Tax Flow podcast. Have a good week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.